It's open enrollment. You're staring at a list of health plans, and the natural move is to pick the one with the smallest monthly price. That instinct can quietly cost you the most money of any choice on the page. Because the monthly premium is just the sticker price, the real cost shows up when you actually use the plan. Today, what each confusing term really means, why the cheapest premium can be a trap, how HSAs and FSAs fit in, and how to match a plan to the year you're likely to have. If nobody ever explained this, that's normal. That's why this channel exists. Quick note, this is general education, not insurance, medical, tax, or financial advice. I'll point you to official sources like healthcare.gov and irs.gov, and for your situation, check your plan documents and a licensed professional. First, the big idea. A health plan splits the cost of care between you and the insurer, and the split changes as your spending goes up during the year. You pay a monthly premium just to have coverage. Then, when you use care, you pay out of pocket up to certain limits before the plan starts paying more. Your true cost for the year is the premium you pay every month plus whatever you spend when you actually use it. Learn 4 terms and the whole thing clicks. Term 1, the premium. That's the fixed amount you pay every month just to keep coverage active, whether you see a doctor or not. On a job plan, it usually comes straight out of your paycheck, often before tax. As an illustrative example, one plan might cost $80 a month, and another $200. But that gap alone does not tell you which is cheaper overall, because the pricier premium often buys a lower deductible. Premium is only the first of the numbers. Now the 3 terms that decide what care actually costs you. The deductible is what you pay yourself before the plan starts sharing costs. After that, coinsurance or copays are the smaller shares you keep paying per visit or prescription. And the out-of-pocket maximum is the ceiling, the most you can pay in a plan year for covered in-network care before the plan pays 100%. Premiums usually don't count toward that max. Read a plan on these 3 numbers, not just the monthly price. Here's why the out-of-pocket max is the number that protects you. Say you have a serious health year. Surgery, a hospital stay, ongoing treatment. The bills could run into the tens of thousands. But if your plan's out-of-pocket max is, as an illustrative example, $6,000 for in-network care, that ceiling is roughly the most you'd pay for covered services, no matter how big the bills get. That's the whole point of insurance, capping your worst-case year. Let's compare 2 plans the right way. Plan A has a low premium but a high deductible. Cheap if you barely use it, expensive if you get sick. Plan B has a higher premium but a lower deductible and out-of-pocket max. You pay more monthly, but a bad year hurts less. Neither is automatically better. The right pick depends on how much care you expect. These are illustrative examples to show the trade-off, not real quotes. But here's the mistake that costs people the most: choosing a plan on the premium alone. The cheapest monthly price usually comes with the highest deductible, so the moment you have one real medical event, you pay thousands before the plan does much of anything. A slightly higher premium with a lower deductible can be far cheaper in a year where you actually get sick or injured. The premium is what you pay to be wrong about your health. Weigh it against what one bad month could cost. In about a minute, I'll give you the health insurance cheat sheet to screenshot. Every number to compare in under 2 minutes. But first, the tax-advantaged accounts that can lower the real cost. And the one factor that beats all the numbers. 2 accounts can make care cheaper with pre-tax dollars. An HSA, a health savings account, pairs with a qualifying high-deductible plan. The money is yours to keep. It rolls over year to year, and it can even be invested. It's the one with the well-known triple tax advantage. An FSA, a flexible spending account, is offered by many employers regardless of plan, but it's mostly use it or lose it within the year, so you fund it more carefully. The detailed rules live in IRS Publication 969. One caution people miss with high-deductible plans and HSAs: the lower premium only pays off if you can actually cover the deductible when something happens. If an emergency would wipe you out, that cheap premium is not really cheap. An HSA works best when you can leave money in it to grow. Match the plan to the cash cushion you actually have, not the one you wish you had. Now the factor that can beat every number on the page: the network. Insurers negotiate prices with a set list of doctors, hospitals, and pharmacies. That's in-network. Go out-of-network and you may pay far more, and it might not count towards your out-of-pocket max at all. Before you pick, check that your doctors and your nearest hospital are in the plan's network, and confirm your regular prescriptions are covered. A cheap plan your doctor doesn't take is not a cheap plan. Now, the one thing nobody tells you: the best plan depends on the year you're about to have. So guess honestly. If you're young, healthy, and rarely see a doctor, a lower premium with a higher deductible can win, as long as you have savings to cover that deductible. If you have a condition, take regular medication, or are planning a big event like having a baby, a higher premium with a lower deductible and out-of-pocket max often costs less overall. You can't predict everything, but a rough guess beats picking on price alone. Here's your 2-minute health insurance cheat sheet. Screenshot this. 1. Don't compare on premium alone. Add the deductible and out-of-pocket max. 2. Know the worst case. The out-of-pocket max is your ceiling for in-network care. 3. Check the network for your doctors, hospital, and prescriptions. 4. See if an HSA or FSA fits, and whether your employer contributes. 5. Match the plan to the health year you actually expect. 5 checks and you can pick with your eyes open. That's the map. The premium is the sticker price. The deductible and out-of-pocket max decide your real cost. The network can beat every number, and tax-advantaged accounts can help. If this helped, the free Adulting Starter Kit in the description has this cheat sheet plus a simple budget template. Next up, how much emergency fund you really need, and why the 3-month rule isn't the whole story. Subscribe so you don't miss it, and check healthcare.gov and your plan documents for your numbers.